Welcome to the video, everyone. Okay, so today we're going to be looking at financial education YouTube channel from the YouTuber Jeremy Lefebvre. I told you guys before we'd be reviewing some YouTube channels that I think are kind of putting some investors and viewers at risk. And to me, this seemed like a pretty good channel to start with. And of course, I want to say real quick, this has nothing to do with tearing anyone down, like any individual person, or going on the attack on anyone. This is more so pointing out things that I noticed from these channels I'll be pointing out, and specific YouTubers, things that I find dangerous to investors, and basically I'll be pointing things out that I do not like that are presented on these channels to hopefully bring awareness, not to bash these YouTubers because they can upload whatever content they want, but to hopefully put a warning out to people. A warning so that people aren't just trying to blindly follow whatever stock trades or investing moves that YouTubers are putting out. So let's get right into it. The first thing I want to point out is how, typically YouTubers, financial YouTubers will say, oh, well, this is not financial advice, so don't listen to me, ha ha ha. But normally the way these YouTubers present their content, and they're basically hyping stocks and shilling content to the point where you can say it's not financial advice all you want, but when you're making something sound great, and you're just kind of presenting the story on a stock and why it's going to be so great and making it sound like sunshine and rainbows, people want to blindly follow what you're doing without doing their due diligence. Because these financial YouTubers made it sound so compelling by the story, the financials didn't really matter. So let's go ahead and take a look at Tattooed Chef here on Robinhood. And I look at Robinhood because I'm going to point something out. It has nothing to do with the price action on this thing, although if we look at the even 1 year, you will see just an abysmal drop. But if we take a look down here, the first thing I want to point out is right here at the bottom. People who own Tattooed Chef also own, I should put a ... here, Corsair Gaming, The Honest Company, Palantir Technologies, Dropbox. Now, isn't it a little suspicious that all these stocks that Jeremy happen to own are recommended stocks under Tattooed Chef, and it's under the section of people also own. So, people who tend to have Tattooed Chef in their portfolio also happen to have all of these here. Corsair Gaming, The Honest Company, Palantir Technologies, Dropbox, all stocks that he owns. So he may say, oh, this is not financial advice, and oh, do your own due diligence, but yet all of his stock courses and his stock group that you have to buy your way into, by the way, and we'll be getting to that a little bit later in the video, he pumps all of these stocks, whether they're good financially or not, or whether they're over or undervalued. He's pumping the hell out of a specific basket of stocks, and he pumps these same stocks on YouTube. So you may claim, oh, it's not financial advice, but when you hype and shill something so much, and in his videos, he really never says, please don't follow what I'm saying or do. You really need to do your own due diligence before buying anything. I'm just presenting, financials, fundamental analysis, and information. No, he just shills all these companies, and normally the ones he shills are the extremely overvalued crap, non-profitable stocks. He shills them, he hypes the story. But again, all people who own Tattooed Chef also own Corsair Gaming, Honest Company, Palantir Technologies, Dropbox. All stocks owned by Financial Education Jeremy. And it would appear that on the desktop version of Robinhood.com, they're not showing anything else. But if you're using the app for Robinhood, I don't use them as my brokerage, but I do use them to like track stocks and like keep a watch list because I just really like the layout. But if you go to the app, it shows more recommended stocks, and all of them that are recommended in showing as people who own Tattooed Chef also own this. It's literally all his stocks in a row. Not even something else recommended. Like, they're all of his stocks recommended all on a big list. You can't make this stuff up, people. This is proof that whatever he is shilling in his stock group and whatever he's hyping and shilling on his YouTube channel, people blindly are following because they clearly are copying, mimicking his stock portfolio. Oh, here's a little more proof for y'all. I clicked on the honest company here, and let's scroll down just to try to get more recommendations. Oh, what? How? Tattooed Chef, Corsair Gaming again, another 2 from him. Oatly Group, Smile Direct Club, sound familiar? So we've clearly made the case that whether he wants to claim, oh, this is financial education or not, he was severely hyping all of these very unprofitable, not financially sound companies, and whether, it's not his responsibility technically as to whether people follow him or not, but follow his trades. But the fact of the matter is he does have a big following and people are mimicking his portfolio. And what the algorithm in Robinhood.com shows proves that, where it literally is saying, oh, you like Tattooed Chef? Well, let me recommend what other people who are buying Tattooed Chef are also buying. And it's all his stocks here. All of them. So now we're going to get to the next portion of my video and just some stuff I want to point out. And that is his courses that he has, because he charges lots of money for basically financial advice while him still putting a disclaimer in there, it's not actually financial advice. That way he doesn't get in trouble when he's promising like 30% returns every year, which beat every index out there. But he's not financially liable if there's a disclaimer in there that, oh, it's not actually financial advice, even though you're kind of paying for financial advice. So he's got 3 different offerings here: course curriculum, private group, beginner, intermediate, and advanced classes. And if we look at course curriculum quick, he's just got a bunch of different stuff here. Oh, private group exclusive lessons, portfolio breakdowns, which is just a breakdown of his portfolio. If you like what he's investing in, which I wouldn't exactly say as of late you would. The Master of Stock Market, becoming Master of Stock Market. Financial Fortress lessons, stock market investing mastery, invest like a pro in less than 24 hours. Yeah, that's an interesting statement. No one invests like a pro in less than 24 hours. Now we've got the beginner, intermediate, and advanced classes here. And if we scroll down, you'll see just overall topics covered. It's laid out nice. He tells you what you're supposedly going to get here. An intro to investing / a mindset for investing in stocks, a long-term strategy, a portfolio setup and diversification. It goes on. Reading financial statements, how to read a 10K, ratio analysis, looking at valuation. Now, the reason that I'm pointing out his stock course, especially for this part of it, is because all the things he's pointing out here about reading financial statements and 10Ks and doing proper valuations and looking at the ratios and setting up a portfolio and diversifying correctly, the problem is he is not emulating any of this in his recent investing. I'm not going to knock Jeremy Lefebvre financial education entirely. He has in the past picked stocks based on actual, I would argue, fundamental and financial analysis. Even when the stock crash first happened for COVID back in 2020, he was picking some reasonable stocks at good prices, I would argue. Like one of them that I thought was a pretty good pick, especially at the price he was talking about it at, was Skyworks. I'm not going to say the guy's never talked about or picked good stocks. I'm pointing out mainly in this last, year, maybe year or two technically, he's become very dangerous for his viewers and just, investors and people watching him. All these things he talks about in his, stock course about how to invest correctly, essentially, I'm sure some of these are actually decent. I don't know. I haven't bought the course, so I don't know. But if he's teaching fundamental and financial analysis in a correct way, I'll tell you right now, he's not emulating that in his investing right now in his stock picks. He's more so emulating, in my mind, something of, oh, I got lucky on Tesla. Because when he made his initial investment in Tesla, Tesla was not doing well financially. He honestly got lucky. And now he thinks he's got the magic fingers and he can just pick the next 10x at all times possible. And he'll just use the excuse, oh, well, you gotta have a 5+ year horizon to see what happens. But by that point, a lot of these companies could either be bankrupt or just still not profitable and really, really screw over any of your viewers or watchers who emulated what your stock plays were. Your stock plays that you heavily hyped in your stock group and what you hyped on YouTube. He's hyped on highly unprofitable companies like Honest Company and, Tattooed Chef is by far the worst one, the worst example, and we'll go into some financials to show you why. It's like he's swinging as hard as he can in hopes that he will hit another 10x stock so that he can then say, I've got the magic fingers again, I know what I'm talking about, even if it means that another 10 stocks he picked completely fail. So I don't know what to tell you in terms of these courses because I have no interest in buying them to try them. There may be some good fundamental analysis and financial analysis advice in here, and stock investing advice, but I would certainly strongly argue that his shilling and hyping of these highly unprofitable stocks that are not based on any fundamental or financial analysis do not exemplify what he's putting in these stock courses. He's not following his own advice. That's when you know things are getting dangerous, when you don't follow your own financial standards that you've set, your own standards of investing. Now, I just want to take you through some of the videos he uploads because for a while here, he started uploading some videos again recently, making stock picks again. And isn't it strange that we had a couple good days in the market and that's when he started making stock picking videos again? Because if everything's going green, people can't get as mad at you, right? But if we look at a lot of these videos, there was a good period of time here, all in here and before, where he wants to make money off of YouTube ad revenue still. We couldn't miss out on that. But he's afraid to talk about his stock picks because people have been writing so many negative comments and he's had so much backlash. So we look at all these videos here. This is massive stock market breaking major trend. So that's going to make you want to look, what major trend could it possibly be breaking? This is awful, massive layoffs coming. What a disaster. Why the stock market just collapsed. Stock market panic has started. Do this now. And and I've watched a couple of these videos out of curiosity, and literally he provides no actual useful information. He's just babbling about current stock market conditions because if he's afraid to talk about stocks right now because he doesn't want more people angry at him, he's just randomly babbling on about nothing and providing no useful information because he still needs to put out videos and make ad revenue. Right? He's got to make ad revenue to make up for all the money he lost in these highly unprofitable stock picks. Highly unprofitable companies with no actual fundamental or financial analysis behind him. He's allowed to make mistakes because it's just covered by all the ad revenue he makes. Meanwhile, other people who blindly followed his stock picks are getting burned because they're not covered by several $100,000 a year that can be made off of YouTube ad revenue. Let's read more of them. The stock market collapse is taking stocks to zero. I don't know, maybe some of his companies will go to zero. These are very, very clickbaity because unless a company literally dies off, no stock is going to go to zero. Wall Street says sell everything now. This is awful. Stock market collapse. Stock market collapse. They tricked us. Stock market collapse. What a disaster. Stock market collapse. This got ugly. Stock market collapse. I think I'm getting tired of saying that word collapse. Oh, thank God he changed it up here. 7 stocks I'm buying heavy now. Stock market crash. Woo! It's a trap. Stock... Wait a minute. 7 stocks I'm buying heavy now. From I'm buying heavy now to it's a trap. And then suddenly, did the stock market collapse just end? Never mind, selling everything in June. This is very bullish. So, did it end to selling everything to I'm bullish to I'm buying this stock next? And 3 stocks I'm buying. So as we have more green days, Jeremy is going to be comfortable enough to come out and start making stock picking videos again. Now to go ahead and wrap this video up, I would have liked to have watched one of his videos in full with you guys and reviewed it. But this video's already kind of been long, and those are just long videos. Hey, longer the video it is, the more ad revenue he gets to make, so yeehaw. But yeah, I mean, some of these are like over 20 minutes or at least 20 minutes, so we're not going to do that. Instead, here's what I'm going to do for y'all. We're going to go ahead and pick 3 companies. Tattooed Chef is obviously one of them. Let's go with Honest Company, and then, I don't know, maybe like Oatly or something. I'll decide on the 3rd one when we get to it. We're not even going to do a deep dive, like reading all the 10Ks and everything. We're going to take a very quick look. I will show you how I look high growth but unprofitable companies and tell you right away if it's even worth my time to look at them or not. That way, maybe in the future, when Jeremy starts hyping and shilling stocks again, but not financial advice, remember. But when he starts doing that again in the future and making more of these stock picks, hopefully I can show you a quick screening process so that you can get an idea of whether you should steer clear of these stocks or not. Again, remember, with a lot of his stock picks as of late, like Tattooed Chef and Honest Company and Oatly and Smile Direct Club and all these highly unprofitable companies, there's not much fundamental analysis and financials that you can look at on the company because that's going to make it look like crap. So instead, Jeremy and a lot of other YouTubers talking about companies like that will in fact just talk about the story only. Oh, yo, bro, look at all the SKUs it's getting in Target. Oh my God. They'll talk all these new SKUs and all these new products and da-da-da-da-da-da, and I don't care about the story. I mean, it's nice to see a good, story, but the fundamentals and the financial analysis have to back it up. Okay, y'all, so the last thing I'm going to leave you off with is we're going to screen some of Jeremy's stock picks, and we're just going to see how they look on paper, because fundamental analysis and financials matter, guys. It does. So, especially with a lot of his picks, what you're going to want to look at right away, because he wants to find the next big growth story, we need to look first at the revenue. And you will see that the revenue is growing pretty decently. 84.9 mil to 148.4 mil to 213 mil in revenue for 2021. And by all means, that's good. However, the first thing I will show you with a lot of these companies is if you jump... Oh, and by the way, this is macro trends. There's lots of websites you can use, but if you type in the company and macro trends... And then you go to the, here I'll scroll up real quick, and you go to the financial section. I like using macro trends. gives you a nice little layout of the financials here. And from here, we can kind of look at some very basic financials where you don't even need to look at a 10K to screen this company and know it's crap and you shouldn't invest in it, at least not yet until it proves itself in some way. So revenue is growing. But if you see high revenue growth, you always want to see one thing. Are they diluting your shares? Are they diluting the shares outstanding? And if we look down here, you can see they're being diluted heavily. 28 mil to 40 mil, and then 40 mil to 82 mil. So I want to just give you guys a quick example here. Let's say that this growth from 148 mil to 213 mil, well, actually, I'll show you guys exactly what it is. Got my handy dandy calculator here. You can just get the percentage of growth by doing 213 divided by 148. So that's roughly what it is. So 213 million divided by 148, boom. So they had roughly 44% growth. It's 1.4, so this is where it is. So 43.9%, we'll call it 44% growth. The shares outstanding more than doubled from 40 mil to 82 mil in that same time period, meaning that your shares outstanding diluted way more than your revenue growth. What that in essence means is that you basically had negative revenue growth. And I can prove that too with another quick calculation. You see how fundamentals, financial analysis, and math actually back things up? So if you don't somehow believe the math that more than a doubling of shares outstanding creates negative revenue growth, even though they add about 44% revenue growth here, let me show you guys something. There is such a thing as revenue per share for your investors. And it's how much of the revenue you get per share. And you want the more revenue you get per share, the better. Well, the problem with TTCF is the more shares outstanding you create, the less revenue per share you get because you're creating way more shares. So for example, in 2020, if we do 148 million divided by 40 million shares, your revenue is basically, for revenue per share, 3.7. So in the following year, to show you that you are getting more value out of your shares, you'd want to see this revenue per share go up, not down. And this will prove your negative revenue growth right here, essentially. 213. And remember, you want to see revenue per share go up. And if we divide the current revenue for 2021 by the current shares outstanding, which is 82 mil, so divided by 82, now it's about 2.59. We'll call it 2.6. So your revenue per share went from 3.7 to 2.6. These are very basic math equations and very basic ratios to prove that you're getting not only diluted, but essentially negative revenue growth because your revenue per share decreased. Now, a couple other screening things I want to show you guys. Get out of here, damn ad. A couple other screening things I want to show you guys is you want to find your path to profitability, and you want to find it on a consistent basis. So here, your basic, or your EPS was like 15 cents overall, then $1.85, but then it jumped to a negative $1.07 earnings per share. So what does that tell us? What do we learn from that? What that tells us is that just because a company, it looked good in 2020, especially with that EPS, but what it tells us is just because a company has 1 year of good EPS doesn't mean anything. What it tells you is that when you're viewing a company, you need to look at like at least a 3 years minimum, preferably 5, of consistent financials showing that the financials are getting better, better, and better. This is proof you could have 1 year that made it look good, but then we jump up and the reality of the situation is shown. It is highly negative on the EPS. The net income is highly negative, and it's just proof that this is, in fact, A share diluting, highly unprofitable company. Realistically, unless you want to take a risk when you invest in a company, you should see a minimum of 3 years of consistent financials going in the correct direction, preferably 5 years. That's when you can start to trust that this is more fundamentally sound and the business model is working and the financials are going in the correct direction, and you can start to trust it a little more. You have net income that's getting worse, and you have shares diluting. So that's basically your quick screening on the company. You can look at the revenue growth and say, wow, it's growing really, pretty good. But that's being canceled out by the share dilution. The fact that the company is still very unprofitable now, negative net income, we're going the wrong direction, not the right direction. Operating income is going in the wrong direction. They're just becoming more and more unprofitable as of right now. We also want to look at gross profit. And you'll notice that gross profit in 2021 barely went up from 2020, while your cost of goods sold went way up. So another basic thing, and I wish that Macro Trends calculated the percentage, because now we got to whip out the calculator again. Let's just compare 2020 to 2021. And for those who don't know, revenue minus your cost of goods sold, that's basically your exact cost of how much it is to produce your product. And after that, what's left over is your gross profit. After that, there are other expenses that you have to take into account. But let's look at these gross margins. So in 2020, it was 21 divided by 148. And you'll see here that your gross margin for 2020 was about 14%. Which, by the way, is a really awful gross margin. But again, Tattooed Chef is already a really dangerous play because you're operating in the frozen food market, which already has razor thin margins, and now inflation came and, well, you get the point. But okay, 14% gross margin. You get that by doing your revenue minus cost of goods sold gives you your gross profit. Gross profit divided by revenue gives you your gross margin, 14%. That's not very good. Then, let's go to the next year, 22 divided by 213, baby. Now it's 10.3. So the problem is your gross margins are also going in the wrong direction. By the way, I remember Tattooed Chef's management was kind of like guiding that by this point they would be at something like 20+% margin, they thought. 22, I think it was. 22% gross margins. And now we're sitting at half that, less than half that at 10.3%. So that's another thing you want to screen. How are the margins looking, especially gross margins? And they're going in the wrong direction as well. Because when your margins are that razor thin, especially gross margins going in the wrong direction, now this is the money or your gross profit you made after your cost of goods sold. There are many other costs to a business, and by that point, because of the other cost, it puts them in the negative on everything. Just for reference, you guys, when we're talking gross margins for a gross profit divided by revenue, you have like tech companies where their gross margins are like 60% or more, usually more like 70%. So this should give you a reasonable idea of where we're at. By the way, I'm going to be doing a totally random, has nothing to do with this video. I'm going to be doing a DCF analysis in the next day or so on Airbnb. And their gross margins are 75 to 80%. Just to give you an idea of what actual good gross margins look like. So let's go ahead and look at one more company, because this video is always already so long. Let's look at the honest company. Let's try to be honest about the honest company and see how we feel about that. And remember, guys, when we look at, I'm not against unprofitable companies. I will tell you that right now. What I am against is highly unprofitable companies that are share diluting and have, here's the key words, no path to profitability. I I'm okay with investing in unprofitable companies because it can really give you an advantage to make a lot of money on a stock. But you need to find a company where you can see a clear path to a positive earnings per share, positive net income. You need to see a path to their profitability and then pencil out their value from there. So we've got the Honest Company, which from 2019 to 2020 had good growth, which is probably, relatively good growth, which is probably what drew Jeremy in, even though from 2020 to 2021, the growth was really, really slow, from 300 mil to only 318 mil. First thing I like to look at, let's go ahead and see how those gross margins are looking. We'll just compare 2020 to 2021, and you can already tell by the look of this that this company has much better margins than a tattooed chef. So revenue about 300 million minus 192 million gives a gross profit of 107 mil. 107 divided by 300. So that gives you a gross margin of about 35.6%. This is at least gross margins where you're getting more into reasonability. I mean, you expect the frozen food market to be really bad, but tattooed chefs' gross margins are just awful. I think if you compare it to other companies in the same section or sector, they have margins that are above 20% at least. So cool, 35.6%. We want to see what direction they're going in. Let's look at 2021. 109 million divided by 318. And, it's the wrong direction, but I'm going to give it to the Honest Company and say, just based on a 1 year, look here and difference, I'm not going to penalize them that bad. To go from 35.6 to 34.2, that's not terrible. You obviously want to see it stay about the same or get even better, but that's not a horrible drop. That's something where we say, let's look at future quarters in, future years and see if the margins get better or not. So as far as I can see, their gross margins are around 35%. I almost thought for a second this said operating income, and I'm like, wow, it's positive. But no, these are their operating expenses, everyone. So, here's your problem. Back in 2019, your operating income's negative 31.4 mil. It tried to look a little better for 2020 at negative 13.5 mil. Then it jumps right back to just being, even worse than before at negative 36.8 mil. So for all the years that we have on this company, it hasn't shown me that it's getting any better with its operating income. It hasn't shown me it's getting any better with its net income. It also hasn't shown me it's getting any better with its net income. And of course, how could we possibly go on without some massive share dilution? That's more than a doubling right there. Kind of like Tattooed Chef. Weird. Maybe a requirement for Jeremy's stocks is that from 2020 to 2021, the share dilution had to be more than double. So whatever little revenue growth they had, you can now kick that to the curb because the share dilution basically killed it. This share dilution killed your revenue per share value. The EPS did get better from 2019 to 2020, but then in 2021 it stayed the same. Look guys, it's, Honest Company, they're still unprofitable. Clearly it's not as bad of a story as Tattooed Chef at a glance here, but I still just don't see enough years of numbers here. I don't see enough years of financials here where I can make a sound investment in this. I can't look at this company and say, wow, I know where the EPS is going. Wow, I can see where the net income is going. It's not clear to me yet a path to profitability. And it's not clear to me if they're going to keep diluting the hell out of their shareholders. And their revenue growth isn't even clear to me here because from 2020 to 2021, this growth honestly stinks. So if you're going to have any takeaway from these two companies that I just looked at, I want you to realize that if you're going to invest in an unprofitable company, oh, this great growth story like what Jeremy seems to present on his channel, and I'm sure to his stock group. If you're going to be looking at companies that are currently unprofitable to look at them to invest in, you need to have a pretty good understanding of fundamentally and financially understanding and analyzing a company and seeing a trend and understanding if there's a path to profitability currently or not. Past that, if you want to invest in actual profitable companies that are more stable, I have a video showing how to do a DCF analysis. I may make an updated video on that. But not only that, I also do a lot of DCF and fundamental analysis on my channel. And I show you how to intrinsically value currently profitable companies with positive free cash flow. It's not often I really invest in an unprofitable company, but if I do, I need to do a deeper fundamental and financial analysis and try to see if I see a path to profitability and where they are trending. And that's going to wrap up this video. Again, just a little disclaimer, as I kind of said at the beginning of the video. The point of this video is not to bash Financial Education Channel and Jeremy Lefebvre, if that's how you say his last name. I don't know. This is to put a warning out to people that you should not blindly follow people just because they have a big following and they may be a charming YouTuber. As they say, you should do your due diligence. You should gain a deeper understanding of how to actually fundamentally analyze companies and do financial analysis. Please do not just blindly follow someone's stock pick, and I mean the whole basket of them, especially when they're all unprofitable companies, as you may in fact get burned. And while I do not personally have anything against Jeremy Financial Education or his channel, I do take an issue with you honestly kind of shilling and hyping these highly unprofitable companies before. Because even if you say, oh, this is not financial advice, people who do not know any better are going to blindly follow your picks because you sound like you know what you're talking about. And you, Jeremy, may have the financial steadiness that comes from all your stock courses and your ad revenue to essentially live with these losses and to keep plowing money into these highly unprofitable companies that make no sense and are share diluting and highly unprofitable with terrible margins. But people who blindly follow you did not have that money to lose, and they blindly followed you because even though you may claim it's not financial advice, you shilled the hell out of these stocks, you hyped the hell out of these stocks, and you made the story sound really plump and juicy. So this is a point to people who invest in the stock market, want to be investors, who are new to the stock market, whoever you are that has seen Financial Education's content channel. Maybe you're thinking of investing in stocks he picks, or maybe you already have. You need to consider more than just the story on a stock, on a company. If you at a quick glance from what I just showed in this video can't see that the numbers are looking reasonable in a 5-year span, if they just continue, or for a lot of these companies only a 3-year span because that's how long they've been public. If you at a quick glance, as I showed you in the video, cannot see these numbers getting better and they're getting worse and it's more share diluting and it's more highly unprofitable than it was before, and the margins are getting worse, that may be a little bit of a warning sign that it's not a very good company to invest in. And whatever point Jeremy or even other YouTubers make for stocks like this on the path to profitability clearly fell flat, so that should teach you a lesson that you need to wait enough years to see consistency in a stock's financials to know where its true path is going. Okay, everyone, that's going to wrap this video up because I have to be honest, my voice at this point is just dying. This has been a very long video. So thank you for joining me for this video. And again, this is just to hopefully help people realize what they're looking at when they're investing in these stocks or watching a channel like that. It's not to bash him. It's just to point out the risk that there is involved with investing in these highly unprofitable, share diluting companies. Thank you for watching, and I will see you in the next one.